This is David Hay, and this is another edition of Haymaker as host. And I'm privileged to have Chance Finucane as our guest this week, this issue. And Chance is at actually one of the kind of legendary firms in the investment business, Oxbow, which is based in Dallas, I believe, right?
Actually, Austin, Texas.
Austin, okay.
Yeah. So
you got the Texas part right.
You got that right. Our managing partner, Ted Oakley, started it in Corpus Christi, and now we're in 4 cities across Texas, but Austin is our main headquarters at this time.
Well, I've got some good buddies down there who you might know. In fact, I think Ted attended a University of Texas game here recently with my good friend Danielle DiMartino Booth and my other good friend Jim Edsel. I think they had a great time, even though the wrong team won in that case. But yeah. So you brought up Ted, and he's got a great reputation in our business. I've listened to him a number of times, read his work, and it's got to be a fun thing for you to work with him. And I think this, instead of doing kind of the overview of Oxbow at the end, I thought we'd do it first. So can you give us a bit of background, when the firm was founded, what your investment approach is, when you joined the firm, and you are CIO currently, correct?
Yes, that's correct. So Ted, it's been a joy to work with him the last 5 years since I joined at the end of 2017. Ted started actually a partnership in Corpus Christi with a couple other people he was working with, but Oxbow really came about in the last 10 or 20 years, trying to have more of a formal RIA type operation. And what Ted's found over the course of his career was interacting with business owners after they sold their companies. He just saw a lot of examples of people who, after working so hard for decades, they'd sell their businesses and then they'd really be in a tough spot in those couple years afterwards. And typically when you sell your business, it's made public and you get a lot of people coming after you with a lot of great ideas of things you can do with that money. And if you haven't thought about next steps you want for your life and what you want to do with your time, as well as what you want to do with this new wealth, you can lead to some poor decisions and end up really cutting into what that nest egg was going to be for the remainder of your life for your family. And so that's our focus, is primarily working with business owners after they sell their companies. And we primarily focus on doing that by investing through 3 strategies. So we have a conservative income strategy that's meant to be very safe, mainly focused on short-term treasuries and high-grade municipal bonds. We have a high income strategy, which is intended to beat the bond market and generate a good amount of dividends and coupons for individuals to live off of, while still protecting the principal value in those accounts. And then finally, we have the long-term growth equity portfolio, which is trying to invest in competitively advantaged businesses that are often growing at double-digit rates. And our intention there is to buy them when they're undervalued and trying to hold them for a handful of years at a time, not turn over the portfolio too quickly, and just let those portfolios grow with the company growth over time.
Great, that's a good overview. And as I said, your reputation precedes you. You are very highly regarded. And it's fun to chat with you because you guys actually manage money and you pick individual securities. I mean, you do deep research. And that's actually very similar to what our firm does as well. And, frankly, I mean, we are both active managers, and the way the world has evolved, we've almost become endangered species. And I would imagine, given your business orientation, you believe that active management is going to have a comeback and is no longer going to continue to, play second fiddle to passive. But I don't want to put words in your mouth. Is that pretty close to what you believe? And if so, how come?
Yeah, we would agree with that. Especially, I think what we've been noticing in research that we've been doing the last year or two is that this next decade, we think, is going to play out differently than what the 2010s looked like, where you basically could just invest in a lot of index funds and hold them for year after year. And you always seem to get 10, 12, 15% growth in your portfolio every year. Any dip in the market would only last for a few months, and then you started going up again. And we think this is going to be a different environment for the next decade, where active management and really having somebody being able to maneuver and adapt and be flexible in the portfolios is going to be more valuable. The best example, if it plays out this way, would be what we saw from the late 1960s to 1982, where you saw the market go up and down through 3 recessions, but really not go much of anywhere. and you lost purchasing power because of the high inflation during that stretch of time. And so what we're noticing is, right now we're in a period where we think there's more downside than upside, so we're conservatively positioned. But there are things happening that we think actually might make inflation more of a factor over the next decade because of just structural concerns with not enough supply being drilled out of whether it's oil or other minerals and resources that are going to be needed around the world. And if you don't end up fixing that with more capital investment to increase supply that's available, anytime you see monetary stimulus or fiscal stimulus, we think that might lead to higher inflation, and it's going to start messing with valuations and profit margins. So it's going to pay to just be able to have somebody managing your money or looking at your accounts that can maneuver from being offensive to defensive when you see those changes occur.
Well, I'm nodding repeatedly. I'm not trying to be a bobblehead doll here, but I just, well, you're preaching to the pulpit. Everything you said is something that I absolutely agree with, and we'll get into that more deeper in the interview. But I think that's a great summary of why this is likely to be a different decade. And in fact, I would say that different from the last 4 decades, not just the last, not just since the financial crisis, but really since Paul Volcker crushed inflation in the early 80s. It's been kind of a no-brainer just to have a balanced portfolio if you're a conservative investor, or 100% equity index fund if you're an aggressive investor, and there's no cash drag, and it's very tax efficient. And so it's kind of no wonder that so much money has flocked that direction. But as we've seen with so many of the trends or the fads, manias recently, that when money comes charging in and really gets to the saturated point, you probably don't want to be there. You probably want to have a different approach. So that's good stuff. And so your podcast right before Thanksgiving, I looked at the title and it said that you're looking for a multi-year recessionary bear market. But then when I listened to your commentary, it wasn't nearly that alarming. So what is your base case right now?
Yeah, it's interesting when you see a headline generated. Sometimes they'll pull something that is going to attract a lot of attention. I think the way we would view it is that maybe a multi-year bear market, not necessarily a multi-year long recession. But I think what we've been looking at is that this seems similar to what we experienced from March 2000 to March 2003. Not that this has to last for 3 years, but you had excessive valuations that led to the start of that downturn in 2000. The actual recession didn't happen until 2001. And then you still had another year of decline in that 3-year bear market before you finally saw a bottom, and you saw some opportunities in September and October 2002, and then in March 2003. So we think because it's been so long since we've had a bear market that's lasted longer than 3 months, much less 12 months or longer, everyone's kind of forgotten that this sort of drawn out period just requires staying patient and monitoring things, but it doesn't really work to your advantage to have this sense of urgency and always want to try and get ahead of the next move where you think the market's going to turn higher. So I think looking into next year, our base case would be that we will go into a recession. We do see some data that suggests the first half of next year might be particularly difficult, especially if the consumer has drawn down the remaining excess savings they had from the fiscal stimulus that was handed to them in the previous 2 years. Once you get past the holidays, that might be a tough stretch. We've also seen, maybe it's later into 2023. Typically, on average, it's about 6 months after the Fed pauses before a recession would start. So somewhere in there, I think we're just sort of monitoring things both from an economic level and then also waiting to see more of a capitulation from investors. And maybe it's due to the fact that you haven't really seen a real significant negative revision in profit estimates for 2023, but we see numerous examples that state that, or predict rather, that you would expect earnings per share growth to turn negative, and probably pretty significantly negative in 2023, whether Morgan Stanley has a model that predicts a 10 to 20% decline in earnings per share next year. We also have seen numbers that look at the CEO confidence surveys, and that tends to lead where earnings per share is going by a couple of quarters, and that would suggest that that's going negative. So things like that, I think, tell us that there's still more adjustments that people have to make to their expectations And that might lead to more selling and better valuations where we might become more interested. But as of now, with where the market's trading, we'd say it's pretty averagely valued or even a little overvalued.
I want to come back to that earnings recession topic because I think it's such a critical one, and also even Morgan Stanley. I'm glad you brought that up. But getting back to the point that you made about capitulation or really lack thereof, when you see the kinds of inflows that have occurred in a bear market year, it's pretty amazing. It's really the antithesis of capitulation. So that's another thing to be concerned about. I think it gets to your point that it's been so long since we've really seen a long-lasting grinding bear market. I'm old enough to remember the 1970s, and actually started in the business in the late 1970s, but was an investor in the early 70s. And that was pretty much a lost decade. And you pointed out, actually, from 1966 to 1982, Dow basically traded from 1,000 to at the peak to 600 or so at the trough, and you lost a lot of ground to inflation in that period of time. But that's so far in the distance past. Even the 2000, 2003 one that you brought up, which by the way was a pretty mild recession, and yet it was, S&P went down close to 50%, and the NASDAQ went down nearly 80%. So it does go to show that even with a mild recession, you can have a very nasty market. So good points. And then if we look at recently, like last week, the stock market went into party mode, and we've had a very nice rally, but last week's was kind of the crescendo of that rally based upon Jay Powell's perceived dovish speech at Brookings. So do you think that the market perhaps is making a mistake and perhaps misread that by thinking that he's done some kind of dovish pivot?
Yeah, we would think that they did misperceive his comments. And I watched a good portion of that interview, and he did sound like his tone was softening, but all that matters is the numbers. And whether you think they go above 5% or a little bit below 5% for where the peak rate is and the Fed funds rate that they're going to get to next year, it really hasn't changed much, hasn't changed a great deal, despite maybe a little bit of a change in tone in the commentary. So if they're still raising rates into February of next year, probably get somewhere between 4.5% and 5% in that peak rate, and then their intention is to stay there for essentially all of next year, I don't think people realize what that does to profit margins and your cost of capital. If we're going to stay at a nearly 5% rate on the short end, what that's going to do for anybody who's got to refinance debt or any M&A transactions that might continue to stall. You're probably not going to see a lot in the way of IPOs. And then if inflation stays higher, which we think it'll stay at least at a mid-single digit level through at least the first few quarters of next year, it's going to continue to be an issue on a profit margin side. The difference that we had in 2022 was that revenue growth was still very strong. I think you were about 10 or 11% revenue growth is what it's probably going to be this year for the S&P 500, but that's going to slow dramatically next year, in addition to the continued margin deterioration, which we would expect leads to negative earnings going into 2023.
It all makes sense.
Yeah.
So it sounds like, related to that, your firm is cautiously positioned currently, and even with bonds, you're preferring short-term versus long-term maturities. You get 4.7% right now on the 1 year. You go out to 10 years, and the yield is more like 340, 350. And actually, that's been a massive rally in the 10-year T-note here of late. It's gone. I think it peaked at about 421 and hit 340 yesterday. That's a big move in a relatively short period of time. So do you think that it's fair to say that longer term bonds, much like stocks, are extended and vulnerable?
Right now, we've got a small exposure to long-term treasuries, but I think we still prefer the short-term treasuries. Typically, if this sort of recessionary type atmosphere plays out, you will see the long end of the treasury curve come down by about 150 basis points on average. So if the peak really is in at about 4.2%, like you cited, then that means maybe we come down to as low as like 2.5% or even a little bit lower into next year. So there may be some more room for taking on more exposure in the long treasury bond. But I think for right now, we're still happy with our exposure to everything sort of 2 years and less on the treasury side, just banking in that 4.5%, 4.7% for clients with very little risk in terms of the fluctuation. So to answer your question, there might be a short-term reversion back a little bit higher in the long-term treasury yields, but if we are thinking there's going to be a recession, we would expect yields in the 10-year and the 30-year treasury to continue to come down a bit further into next year.
Well, supporting your recession argument, we've got a deeply inverted yield curve. And even Jay Powell's favorite one, which wasn't inverted until fairly recently, which is the 3 months versus the 18-month, has gone up, pretty severely inverted as well. And when that happens, kind of to what you were just saying, you generally want to extend duration. So and maybe it's a little late to do it after the move I just talked about, but why do you think this time is different? Because you're kind of making the case that, hey, it makes sense to extend duration, but we're not doing that yet, even though we think a recession is going to happen. And you must have some reasons why you're not, making more of a play on longer duration.
Yeah, I think the main reason for us just going through this 2022, basically since 2007, the certain characteristics that you could kind of play in the long-term treasury bond market played out very consistently in terms of opportunities of when to add your exposure and then when to reduce. And this year caught us off guard. I think we increased our exposure to the long treasury bond at a point in time that, looking at 15 years worth of history, would have been the right time to add exposure. And I think people who had gotten used to that, we talked to Lacey Hunt and Van Hoisington, who have an excellent long-term track record in the long treasury bond. But everyone who had that sort of mentality got caught this year. And we got caught a bit as well with a little bit too much exposure, and rates went higher than they previously ever had during this sort of a cycle. So I think we're just trying to keep a little bit more of a moderate exposure, and that we think this now has taken hold of what we thought was happening earlier in the year. We think that's now happening. So to your point, it is sort of a time that you'd want to be taking a little bit more exposure to the long treasury bond, but we're trying to still have some humility, just knowing that these factors are playing a little bit differently than what they have the last 15 years. And we want to have a little bit more confidence in what variables are most important if this is going to be a little bit different environment for bonds going forward.
Well, it's a good point, and I share your, I wouldn't say confusion, but I guess maybe your ambiguity about the bond market right now, because in the past, whenever we've had an inverted yield curve, portfolios that I run, bond related, we've extended maturities and duration. But this time it's tough. It's been tough because you've had such a high inflation rate. And I think in listening to your recent podcast that you believe the Fed is likely to have to kind of throw in the towel at some point on their 2% inflation target and accept a normalized inflation rate that's more like 3, 4, 5%. And if so, that means, buying a 10-year treasury yielding 3.5 is not exactly a great, longer term investment. So again, I don't want to put words in your mouth. I mean, do you think that we're looking at a structurally higher inflation period for the next 5 years or so?
Yeah, we would say that's possible. If you go back 20 or 30 years and the average inflation rate was more like 3%, then it fell to where it's been more like 2% the last 10 or 15 years. And we think it's definitely a possibility that you have to factor into your portfolios that we're headed back to that higher inflation level through a cycle. And to your point, that's going to play or wreak havoc on long-term bonds. And so even though there might be a short-term opportunity here over the next, say, 6 to 18 months in the long-term treasury bond, we would be very cognizant this time around of when we need to lighten that exposure or get out entirely, because if inflation is going to reaccelerate, let's say there's a scenario where the Fed and other central banks cut rates to try and boost the economy, we would expect inflation to take hold again, and we would need to be out of the long bond. And that's a different environment than what we had from 1982 all the way up until 2020 or last year. So I think that's where we're getting more tactical rather than relying on that secular trend that you had for nearly 40 years.
That makes total sense. And I think it applies to the equity side as well, that instead of just this buy and hold mentality that's been so effective since the early 80s, that it's time to be, more, not trading oriented, but certainly more willing to take profits in these big run-ups and then buy when you have another big decline, whether it's with the bond market or the stock market. So given what's happened here lately to both stocks and bonds, in fact, investment grade bonds have rallied almost as much as the equity market. So, and that's an area where we actually were doing a lot of buying here recently, but now we're seeing spreads tighten. I think that's something, a point that you made, is that spreads have come down pretty substantially. Maybe that's a good thing to talk about, because I believe, and I suspect you would agree, that credit spreads have a tremendous influence, obviously, on the bond market, but even the equity market. So right now, high yield spreads, which have gotten up to about 606% over treasuries, are now about 4.5 over 450 basis points. And in a true recession, they go even higher than 600 basis points above, right?
Yeah, the last 3 recessions, that spread got to 1,000 basis points. And so I think what you noticed the last couple of times we had a bear market was when you saw the high yield spreads get to around 700 basis points. That would be where you'd see the Fed capitulate and try to do something to assist the market, and then spreads would compress. But this time around, if Powell really wants to try to be the next Volcker and keep rates high for an extended period, you could see absolutely a blowout where high yield spreads go to that 1,000 basis point level. And the other thing that we noticed too was just in terms of sort of default rates or what's expected, you recently just had a default rate, I believe, of less than 2%. But you've got, I think, somewhere around 8 or 9% of high yield bonds trading at distressed levels at that greater than 1,000 basis point spread. And normally when you see a distressed high yield bond, that means it's likely to go about a 50-50 chance it will go to default over the next 12 months, which would suggest that the default rate over the next 12 months is going to go from less than 2% to above 4%. And I'm not sure that people are really factoring that in, given that spreads are as relatively tight as they are. The average high yield spread over the last 25 years is somewhere around 5 to 5.5%. And like you said, we're at about 440 right now. So it's unusual considering all of the slowing numbers and deteriorating numbers you see in the economy. And yet we're at below average spreads on the most junky sort of bonds out there.
So just for our less sophisticated listeners, the handful that are out there, most of our subscribers and followers are very knowledgeable, but when we throw out terms like basis points, 100 basis points is equal to 1%. We're talking about spreads, we're talking about credit spreads, the difference between what a corporate bond pays and what the government pays, just to give a little tutorial there. But what you're really saying is that with these high yield spreads, they could easily double from where they are right now.
Absolutely.
If it's even just kind of a garden variety, or maybe a little worse than a garden variety recession. And that would be shocking, not only to the holders of higher yield bonds, but also to equities too, because it has a very nasty blowback effect on the stock market. So it sounds like, from what you said earlier, that you do expect a fairly serious earnings recession. And you mentioned Morgan Stanley, and Mike Wilson is, of course, their head strategist there. And I think he's one of the best on the street. He gets flack when the market's strong and he's saying, hey, things are running ahead of themselves. You might want to start to raise cash. He gets called a bear, even though he put out a really good bull recommendation back in around the 10th or 11th of October, and really taught that rally, precisely. So also, perhaps this is going to increase your conviction about the earnings recession call, because CNBC's most famous talking head, I don't think I need to mention a name here, thinks Wilson is wrong. He was dissing him actually earlier this week. He thinks earnings will be fine outside of technology. He also thinks that there's not going to be a general recession. His forecasting record is, to say the least, not the greatest. So again, you may take some encouragement in that. But anyway, how far above trend do you think corporate profits are currently?
We actually saw this chart that stretches back 20 years. Artisan Focus Fund, the money manager for that mutual fund, posted a chart in his most recent quarterly letter just looking at the trend growth rate in the S&P 500. And I think now everyone's expecting $230 per share for next year for the S&P 500. But that trend, which it's fluctuated around that growth rate, would actually say more like $200, be back more towards what the trend has been back to 2004. And everyone, I think people are assuming 250 for 2024 for earnings per share for the S&P 500. So it just seems like everyone's kind of extrapolating out the growth rate that came out of the pandemic and all the stimulus that we had, and money being shipped off everywhere to buy all sorts of goods, and then shifted over to services this past year as people were able to go out and travel and do more experiences. But we think that getting back closer to that $200 number is probably more likely over the next 12 to 18 months.
That makes sense to me. Now, I do think earnings estimates have been and continue to be too high. And, part of what's made it look better for the forecasters who are pretty optimistic coming into this year is the energy. Energy's had a tremendous contribution. I believe if you back out energy, the earnings have already gone negative, and it's going to be difficult for energy to continue to have the kind of numbers that they've had, especially with oil pulling back. We'll get to energy because I think that's a pretty interesting setup that's going on there right now. But does it concern you that the majority of economists, first of all, they are saying, a slight majority is saying a recession will happen, which is pretty unusual. They typically miss it, but they do believe, and I think Wall Street in general believes it's going to be a mild recession. Does that concern you? Do you think the likelihood is that they maybe have the recession call right, but the severity wrong?
Yeah, that could be. I think we share your sentiment that if all the economists agree with you, you probably need to double check your thesis. But I think there's enough data and numbers to suggest that that is the outcome, and it's just interesting. Maybe because it's been so drawn out, people have had time to come to that conclusion. Yeah, it absolutely could end up being more severe than people expect. One thing that's interesting that we've been looking at is just, for instance, the unemployment rate, and labor has remained strong, but labor is sort of the last lagging indicator before it turns over into a recession. And actually, those 3 recessions in the 1970s and early 1980s, it wasn't until several months into each recession before the monthly non-farm payroll numbers actually turned negative. So people think that, oh, look, the labor economy is good, everything's fine, but that's going to be the last thing that shifts. And the thing that I don't think people realize, like, for instance, the Fed's numbers for next year, I think that's just a little bit naive. They're saying, oh, well, right now the unemployment rate's around 3.5%. We think it could go up to 4.4, something like that. But if you look at every single recession going back to 1949, the lowest amount that the unemployment rate increased by was 2.2%. And the lowest peak unemployment rate coming out of a recession going back 70 years was 6%. So if we're at 3.5 now, if we go into a recession, there's no way we're not getting to at least 5.5 or 6%. And the unemployment rate, which seems to be lower than what everybody is anticipating.
Yep, I'm right there with you. And you made a great point that, this is one of the interesting things about the Fed currently is they seem to be focused most of all on 2 things: the jobless market. They actually do want to see the jobless rate go up, which is unusual for the Fed. But that's because of their second main focus, which is inflation, trying to get inflation down as close to 2% as they can. And so they're really in this, with this Hobson's choice of do we take a serious recession on by trying to drive up unemployment enough to get inflation down, or do we accept, as you were talking about earlier, that structurally higher inflation rate? I believe that eventually Powell's going to have to relent and do what he did back in 2018, but I think he's going to put up a tougher fight this time. But it sounds like looks like you agree with that he's going to be tighter for longer. But then eventually there's going to be an awful lot of pressure on him.
Yeah, we agree. It's going to be interesting because I think he has every intention of trying to keep those rates high for as long as he can. And I think there was an economic paper that Jason Furman cited in a Wall Street Journal op-ed that showed that you need to get unemployment rate up to 6% to get the inflation rate down to 2%. But that's going to be painful for the economy and for a lot of people if Powell is willing to wait that long and see the unemployment rate increase to that level. And we agree that's about how high you need to get the unemployment rate to have inflation come down to their target. But if there's too much pressure from other parties, or he's just feeling pressure and needs to flip, that's where, back to our talk about active management of portfolios, it's going to be crucial to kind of know when that happens. All right, it's time to switch from conservative back to being more aggressive with our portfolio and really thinking about what's going to benefit from accelerating inflation, the possibility of growth turning back around and accelerating. And it's just going to be that back and forth and monitoring really closely what he and other central bankers decide to do.
Well, on that topic of Powell and tightening and how far he's going to go, one thing that I think is not getting enough attention is that this is only the second double tightening. And so what that means, again, for the folks that aren't don't watch this stuff real closely, that the Fed is not only raising interest rates, and has raised interest rates at a very rapid rate, one of the fastest rates on record in history, going back basically to the Volcker inflation attack, but it's also shrinking its balance sheet. So it's doing the opposite of quantitative easing, where they were, buying lots of treasuries with money that they just created from their magical money machine, and now they're actually going the other way. So they're draining liquidity out of the system, and by doing so, it's kind of a stealth tightening. But it started out relatively slowly, but it's starting to we get to the maximum, roughly 100 billion, a little under 100 billion dollars per month. So that could, from numbers I've seen, I'd be interested if you have a perspective on what that equates to. But I've seen that over the next year, that could be another 200 basis points of equivalent rate hikes. Looks like somewhere in that. I know it's more art than science with that. What is the true relationship?
Yeah, I think we've seen different numbers too. The most recent one we saw was that 95 billion per month that rolls off, and the quantitative tightening equates to about 20 basis points if it was considered to be like an interest rate hike. So call it 240 basis points if they kept that up through all of 2023. So even if they do pause the rate hikes, you'd still have that essentially additional tightening. We had seen Felix Zuloff, I think, pointed out that M2, or money supply growth, adjusted for inflation, is the most negative it's been since the 1930s. And that's just a very difficult environment for financial asset prices to sustainably move higher. So as long as you're going to see that tightening, both the stealth that you're talking about and still a couple more rate hikes, it's just going to be difficult to feel like, oh, we should really get aggressive and take on a lot more risk.
I'm smiling because I listened to Felix with my great friend Grant Williams at a podcast here a week or two ago, and that's exactly the point he made. That really caught my attention, that when you look at it in real terms, the money supply has already come down drastically and kind of alarmingly, but when you adjust it for the high level of inflation, it really is a Great Depression flashback, and that's a pretty staggering statistic. Another thing I think which is not getting nearly enough attention is the bursting of the global housing bubble. And I heard you make comments, which I agree with, that the U.S. banking system is in better shape to handle the bursting of this one. But prices did get even higher, even if you adjust for inflation, than they were in 2007 in the United States. Then in a lot of countries around the world, Canada, New Zealand, Australia, obviously China, the real estate market's a mess. Their bubble popped, a while ago. But the Nordic countries, where they had even negative interest rates, where borrowers were paid to take out a mortgage in some countries. So prices got even more outrageous, and those prices are now coming down. So it does appear that we do have a bursting global housing bubble, and that's got to have severely negative economic ramifications. But am I too worried about that?
No, I wouldn't say that. Yeah, I wouldn't say that's the case at all. It's interesting, in looking at other countries, the mortgages that are taken out in other countries. We're the only country that has a 30-year fixed rate mortgage. That's the great benefit that the U.S. government provides people. In other countries, it might be a very cheap healthcare, but then if you want to buy a home in Canada or the UK or other countries like that, you're taking out a 3 or 5 year mortgage that then you have to, essentially, it's like refinancing at whatever the new market rate is. And I really feel for people in other countries. For instance, in the UK, that market mortgage rate for a 3 year mortgage was 1.6% in January, and right now it's 5.9. So you can imagine if your 3 year period is rolling off and you have to take out a new one, but it's going to be double or triple the rate that what you had before, what that does to your monthly payments. Can you afford it? At the same time, you're dealing with higher costs, and your wages are probably not increased in line with that. And that sort of reverse wealth effect is going to probably really take hold at the end of this year and then into 2023. We had seen some data that suggested it was still a positive contributor to consumer spending and to GDP growth as recently as this summer. But now the rate of change has turned over, and it's decelerating and will actually turn negative heading into 23. And we would expect that is an additional reason why you might see a reduction in spending. And it surprised me how abruptly it changed, but the luxury goods spending turning to essentially flat year over year and probably heading negative. We'd already seen that the bottom quintile of the income distribution was having a tougher and tougher time, but people were still spending on luxury items, and that now has gone flat and is probably going negative. And that's usually the last area you see for weakness before consumer spending really starts to fall off.
All good points. And I think especially that when you look at these overseas housing markets, that you have relatively short-term mortgage debt, and in some cases, in some countries, a very high level of variable rate mortgage debt, where the interest rate hikes are hitting almost instantaneously. So you're right, there's a tremendous squeeze going on in certain countries. And again, I don't think that gets the press it deserves, especially in the United States, where we tend to have kind of an insular view of things. So the big news today is China's accelerated reopening, or attempt to. And do you think that's going to alter your investment outlook in any way? Does it make you more bullish on certain areas that have been hurt by China's lockdown?
It's possible. I think we had owned a little bit. We owned a couple of Chinese stocks in 2019, 2020, and then sold out of those in 21. And I think, yeah, well, we still took some of the hit as it rolled over, but we're able to get out intact. But I think from our perspective, we really are not trying to make calls on Chinese stocks going forward, just given the ambiguity of the government oversight of a lot of the growth businesses, or what businesses you might want to invest in over there, as well as the regulatory framework with ADRs and what's going to happen there here in the US. But I think you can always look for other ways to get indirect exposure, whether that's owning a luxury goods company. We wouldn't buy one now, but things like that have exposure to the Chinese consumer. So we do own like Nike and Starbucks. So that ends up being a boost if you start to see an increase in Chinese consumer spending. What's been interesting to us is that as this news has come out about a reopening, you're starting to see an up move today in Chinese stocks, but there hasn't been quite such a huge positive impact on the markets that I might have thought it would have been a month or two ago when this narrative was building. So maybe it's just as the sort of global recession or global slowdown takes hold, a Chinese reopening isn't enough on its own to improve things. So it's something that we're monitoring, especially in relation to commodity prices. But you haven't really seen that affected in the oil price, which was a big part of the narrative for the oil price hanging on, and energy stocks staying higher. And right now that has continued to sort of move down on average in recent weeks.
Very good point. I'd like to get to that in just a little bit, but you mentioned Starbucks, you mentioned Nike. I believe you also are bullish, or you own some dependable growth stocks like Visa, MasterCard, O'Reilly. But they're all great companies and they're in long-term uptrends, but they're not cheap. I mean, they're relatively pricey. So are you actually willing to buy them here? I mean, I know if you have a new account, that's one thing, but as far as for existing accounts, are you committing new capital to those kinds of names, or are you going to wait for a pullback?
What we do, and the beauty of having separate accounts rather than say a one mutual fund or ETF, is that we can have good price discretion of when we buy in. So what we typically do is we've got our list of companies often that we've owned for years for our existing clients. And we try to hang on to those winners until you really see either fundamental or price trends break down. And then we have a consideration of whether we want to liquidate the holding. So we'll keep the positions that we've owned for years and the names that you've mentioned. But when they're trading above our fair value, we're not going to jump in and buy for a new account that wants equity holdings. We're going to wait to take advantage of that volatility in the market and buy a half position or a full position as we get to prices that we think represent a discount to what we think the stock is worth. And so that allows us over the course of several months or quarters to be able to build in that portfolio for a new client, but at a price that we think, all right, we're not overpaying here. We're getting things at a good level that we think will generate a decent return that will be able to grow over time. And it also saves some liquidity for if you have a real big sell-off, then we've got a lot available to really take advantage. And for instance, in March 2020, that was a really great time that we had some clients that we just had in the conservative strategy and maybe the high income strategy. But then when things started to really break down in mid-March of 2020, we could call them and say, all right, now's the time. We really want to get an equity portfolio going the way that we discussed, and you're able to buy in at great prices.
Did some people actually say yes? My experience is when things get really scary, the clients, they talk a big game before the price collapse happens, and then they freeze. But it sounds like your clients went along with you, or you were very persuasive.
It worked in this case back then because I think the decline happened so quickly and everyone was so concerned about their personal health and the health of their families with the uncertainty of COVID going around, that I think the concern that you citing about your financial health and watching your portfolios go down and maybe that making people more risk averse, I don't think that was as much of a factor last go round. We'll see if that ends up being a factor when we make that pitch to clients that have a little bit more equity exposure this, whenever it happens next in the next year or two. But our whole focus is just trying to be very transparent and build trust in those relationships so that they believe us and they trust us when the time comes and says, this is the time that we really think that stocks could double over the next 5 years, and it'd be a great time to have some exposure.
Well, on the topic of kind of the opposite of the higher priced steady eddies is the energy, because that is about as cheap as any sector can be when you look at things like PE and price to free cash flow and in many cases dividend yields. It sounds like you guys prefer midstream, the energy infrastructure names. So basically the owners and operators of pipelines and storage facilities and fractionation plants and mostly pipelines. I mean, that's really where I think the bulk of the assets are. But are you comfortable mentioning any names? Or I'll give you one of mine if you give me a one or two of yours. But what do you like there?
Yeah, actually, I think we both own enterprise products at both of our firms. That's our top holding. It's just it's the best all around pipeline. They've got exposure to the Permian and the right places, and it's well managed. Pays a very high dividend, and we've owned that one for clients in our high income strategy for years and years. I think what we've done is we try to have sort of a core 2 or 3 different pipelines that we own, and then when we get really positive about the direction of the oil price and energy stocks in general, we'll add a few more that have a little bit more volatility to their share price, but just as smaller positions, they can really provide a great return over that period that you want to have a little bit more allocated to that area. So like that might be, we don't own these right now, but that would be like a Valero Energy or Devon or Pioneer, those types of companies that are going to fluctuate a lot more with sentiment around oil. And then we'll still have a little bit of exposure to some other sort of stalwart names like the Chevron. We also like, if we can find an oil royalty business that we've owned Brigham Minerals for a number of years. And that's one that we'll kind of adjust the position size based on our outlook for oil. But we typically have some exposure to that just because the business model for an oil royalty or any sort of resources royalty business is just outstanding.
Well, I'm a big fan of Bud Brigham, and he's the man behind that one. And that's they're actually doing a merger right now, which looks like it might be a bit accretive to unit holders. But my name to give you, you probably have looked at it. It sounds like perhaps you don't own it. It's a 9 and 9, and by 9 and 9, I mean it's a 9% yield and 9 times earnings, though actually even a little better than that. And it didn't cut its distribution through the 2 different oil busts that happened. One being related most recently to COVID, and then the breakdown that happened back in 2014, 15. But it's like most of these companies, a great thing that unlike back then when there was such an investment cycle going on, it's the same thing you were talking about earlier, where it's very hard, number one, to build a new pipeline, but they're also they're opting to pay down debt and to buy back units, which is just we never thought that would happen in midstream. So this one is MPLX, which is basically the midstream entity for Marathon. So it's and they just continue to perform very, very well, and it's just remarkably cheap. But you're right, enterprise is the class act, and it's actually not gone up that much this year on a really good year for midstream. I think it's only up 14% or so. Pretty good entry affiliate.
Yeah, actually, we still think it's undervalued today. So that is one that we look to buy for new clients in the high income strategy. And we've owned MPLX in the past. That's one of our preferred MLPs. And it's probably one we would look to own again when our outlook turns more bullish on oil. I think right now it's an interesting period. I remember you talking about it. I listened to your interview with Grant Williams, and it's just an interesting time because that structural deficit between supply and demand has not been improved because there's not enough capital spending in the industry to drive that supply higher to what we need it to be. And yet, when you've got demand declining, due to all of the monetary tightening around the world and potentially heading into a recession. During an oil bear market, it typically takes over a year to play out, and the average price decline is about 60%. And so we've kind of been monitoring both sides, and I think that's why we took our exposure down in the first half of this year to oil in the high income strategy, but we would be monitoring it so that we have an opportunity and make sure we take advantage to add back to that exposure in high income, and probably add some in the equity strategies as well when the time comes that we think the demand is going to turn, and then that structural imbalance will start to become the prominent factor again.
Well, on the oil topic, there's a couple of things that I don't think I've ever seen before. One is that you're talking about oil could go down 60%. It's down 40% already, and not abnormal. With the recession clouds building on the horizon. But what is abnormal is when you look at inventories, particularly if you adjust for the SPR, Strategic Petroleum Reserve releases. Inventories are not just low; they are stunningly low, like dangerously low. So I've never seen oil prices come down like this with the kind of inventory situation we have. And as you point out, the chronic underinvestment. So it seems like there's just quite a disconnect between the actual physical demand and supply for oil versus what's happening in the paper market. And I'm sure you're aware of this, but I don't think many of our listeners are, that the paper market for oil is about 30 times what the actual physical market is. In most commodities, it's more like 3 to 4 to 5 times. So what's happening in the derivative market, the futures market primarily, overwhelms what's going on in the cash market. And you can get these real odd divergences at times. But I have to say, this is one of the strangest ones I've ever seen. But also under the kind of the Ripley's Believe It or Not category is the fact that you've got like XLE has actually had a killer year, despite the fact that oil prices are down. And since early August, oil prices actually have fallen a fair amount, and XLE has gone up, which is, the energy ETF that owns a lot of those names you were talking about. So what do you think the reason for that is? I mean, this the divergence between the equity performance and the actual commodity performance.
The only thing I could think of would just be that people are seeing through the short-term cyclicality and looking at the structural concern and thinking that, we're not going to fall for this. We know where the end game is going to be, and therefore we're going to stay owning these different oil stocks. And we had looked early in this year when oil was trading about at the price that it is now. XLE was trading between $60 and $70 a share. And so we were always thinking, okay, if it got back to that level, then we'd start looking to try and maybe pick off some names and increase our exposure. And what's ended up happening is, as you pointed out, it's still staying up in the 80s in per share levels for XLE, and has not followed the oil price back down. So I think it's just sort of a tug and pull between which is going to win out. Is it going to be the economy if there is a recession and demand comes down and that oil price continues to fall? Or is everyone really just going to ignore that part in the short term and stick with owning all of these stocks? And I guess right now we're sort of just kind of have a little bit of exposure to each side is really the only way, because we just don't know which way it's going to go. Historically, you would say the oil price will win out and the stocks will follow. That's what happened both in the .com 3-year bear market, as well as the 2007 to 2009 recession and bear market. Oil price stayed up into June of 2008 and then finally rolled over, and the stocks followed. So we'll see if that's the case this time. But right now, the prices that are, the oil price that's being embedded for where these energy stocks are currently trading is significantly higher than what is actually on the market right now.
Yeah, I think if you look at you mentioned 07, 09, so the Great Recession, and I believe for the year 2009, oil demand, or maybe during the worst of the recession, oil demand fell about by an annual rate of about 1.5 million barrels a day. But that's about what we've got OPEC saying they're going to cut net, and China reopening probably will be another 1.5 million barrels a day, because their demand is down at least that much due to all their COVID restrictions. Then you've got the fuel switching, which I think is still off the radar of a lot of people in Europe, where for the first time ever, they're going away from burning coal and gas to produce electricity and actually burning, primarily diesel oil. So it's you add all these different things, and you've got like 5 million barrels a day of, plus Russia, and the fact that Russia is probably going to lose some degree of output, although they're pretty clever about how they get around the sanctions. But nonetheless, it looks to me and to us like you've got multiples of whatever the demand shrinkage might be due to a recession. So, but it is interesting. It's almost like oil itself is now a better buy than the equities, but they're both probably attractive.
Yeah, that could be. And if this, if the scenario you're outlining where all those different puts and takes lead to the oil price moving higher, that would just accentuate in our mind the final outcome for the economy, where that leaves inflation up for longer and really puts central banks in a tough spot in terms of having to leave rates higher for longer, or you just let inflation go and it really stays higher for an extended period.
Well, that's a good point. It seems to me that could be one of the big surprises of the first half of next year is another spike up in energy. And I did hear that famous talking head from CNBC today say that you should sell oil into this little mini rally we had today on the China reopening news. So if we did get triple digit oil prices again next year, that would be tough on the economy, and it would be that stagflationary kind of scenario that's always rough on non-commodity equities. So anything else you'd like to cover, Chance?
No, I think we've hit just about everything. I think one other thing that we just saw that was interesting, I get asked a lot about financials, and one other space, I don't know, your exposure to that, but typically you've got two different types of financials. You've got your banks and your consumer finance names that move a lot more with the economy, very cyclical. And then you have your insurance businesses and insurance brokers. And we had read a report recently that just pointed out that this is probably the best past year for insurance and insurance brokers in a long time, because that's where everyone's hiding along with other defensive sectors. But historically, when that happens, you don't usually want to be in that space much longer. And those are businesses that in our estimation are undervalued or overvalued today. And at the same time, we still think there's more deterioration to go for the banks and consumer finance names. So when we get asked about financials, it's kind of just to stay away on all cards, unless you're owning something like a Visa or MasterCard, which is a bit of its own business entirely. It's separate from those others.
Yeah, a much stronger, more persistent business model. Okay, well, that's Chance. Has been I've really appreciated the chance to chat with you and get to know you, and I've been impressed by listening to you, and both today and when I heard your Thanksgiving or right before Thanksgiving podcast. So you got a great way with words and a great handle on the financial market. So I really appreciate you taking some of your precious time to be with me and with our viewers, and just wish you a very Merry Christmas. And I hope you get some downtime during this time. I'm sure you deserve it and need it. I know I do.
Yeah, definitely. It's been a long year, but very interesting year. And thanks a lot for having me on the show.
Absolutely. We'll do it again.